All right, welcome to our annual State of the Markets presentation. We're very happy to have all of you here today and look forward to sharing some important information with you. We're getting everything lined up here, so bear with us a moment. Before we get started, we'd like to go over a couple of housekeeping items. Obviously, cell phones aren't an issue because we have you all on mute at the moment. But if you want to just make sure we're ready, we have a lot of information to run through. And also, we want to point out that if you have any questions, because this is a webinar, not a in-person discussion, please use the chat feature of WebEx, and you can type in our questions, and we'll try and get to them as soon as we can. Here are a few disclosures I'd like to draw your attention to so I can keep the regulators and the attorneys happy. Investment advisory services offered through Paulson Wealth. Nothing here is guaranteed, and this is just an informative discussion for us. So our goal today is to educate you about some of the factors we in the world's financial analysts are watching. While it would be impossible for us to cover everything, we'll try to cover the most relevant factors. And while past performance provides no guarantee of future results, we can pick up on trends to help guide the decision-making process when investing. So here's what we're going to be talking about today. First off, putting 2015 into perspective, factors affecting the stock market in 2015 and 2016 forecasts. So let's start off talking about 2015. Let's take a look at a snapshot of how the S&P 500 performed last year. Now we know that this isn't a diversified basket that our clients have or what most people are invested in, but this is a great example. So for the year, the S&P 500 ended basically flat, losing less than a percentage point over the whole year. In the first couple of weeks of 2016, stocks fell again, causing the S&P to drop nearly 8%. While that's frustrating for stock investors, I want to put that performance into perspective. First, since the worst days of the financial crisis, the S&P has returned over 200% during a bull run that's lasted over 80 months. Is that bull done running? We'll discuss that later in the presentation. Second, markets faced down a lot of challenges last year. We had a lot thrown at us in the form of a slowdown in China, a slowdown in Europe, plummeting oil prices, terrorism, and more. The fact that the markets ended flat or down slightly negative is a sign that the market is resilient in the face of some serious concerns. We saw a pullback in August when the S&P tumbled into correction territory. Why didn't we freak out? Because corrections are a normal and healthy part of market dynamics. We've seen more of that at the beginning of 2016. Why might that be? A couple of reasons. One, many of the issues that markets struggled with in 2015 are still with us. Two, volatility events tend to cluster, which is another reason why we're not surprised to see high levels of volatility going into 2016. We'll talk more about some of the factors affecting markets a little bit later. In the last chart, we saw that stocks didn't have a great year in 2015. However, we need to put that into the context of the challenges that markets face down. Did 2015 meet expectations? Certainly not, but let's take a look at this chart here, which shows the performance through December 23rd of 2015 of 17 different asset classes, ranging from U.S. equities and international equities to fixed income and commodities. Right off the bat, we can see on the far left that commodities were big losers last year. Emerging market stocks and high-yield bonds didn't fare much better in that rising interest rate environment. On the far right, we can see the growth stocks performed reasonably well given the headwinds the markets face. Now, in case you're not familiar, growth stocks are shares of companies that are expected to grow at an above average rate. One of the key benefits is that high growth companies seek to achieve their goals despite challenging economic conditions. Now, that's not to say that they always accomplish those goals. However, 2015 was a decent year. One of the many reasons why we stress diversification so much is because of years like 2015, where asset classes and sectors achieve a wide range of results. What was up last year may be down this year. That's just how markets are. So what's the big takeaway from this chart? Though the S&P ended the year slightly negative, you can see that there were many different winners and losers of a much wider range than that. Again, markets faced down a lot of challenges last year, but they didn't go off the rails, and some years that's a win. So now let's move on to talking about some of the factors that contributed to stock market performance in 2015. Markets got off to a rocky start at the beginning of 2015. That's hard to remember with the start of 2016. And that volatility followed us for most of the year. In January, stocks slid backward from their year-end highs on worries about global economic growth. Markets had a rocky spring because of continued worries about the global economy, but reached a record high in May before pulling back again in June on worries about none other than Greek debt. After creeping upward, markets plummeted by over 11% in August when China shocked the world by devaluing its currency. The devaluation was widely seen as an admission that the world's second largest economy was in trouble, and investors reacted by hitting the eject button. Weak oil prices also have helped the correction, along by fueling fears of a global slowdown. However, stocks didn't stay down long. By November, the S&P 500 peaked with close to record highs, again before giving into jitters about oil prices and the Federal Reserve's interest rate hike. So again, what's the takeaway here? Today's stock markets are volatile, and inter-year declines are quite normal. Even when it feels like the sky is falling, it's important not to panic. Sit down, take stock of what's actually happening in financial markets, and make prudent adjustments where necessary. We'll talk a bit more about corrections and declines in a little while. Now let's talk about oil. You may have seen a lot of headlines last year about how low and volatile oil prices affected markets. Isn't cheap oil a good thing? Well, there are some pros and cons to low oil prices. For U.S. consumers, cheap oil translates into cost savings across the board. Cheaper gasoline, which is a big break for Americans, also makes it cheaper to put products on shelves and lower manufacturing costs. These cost savings help keep inflation in check and may continue to put money in folks' pockets in 2016. From a high of $3.71 in April of 2014, gas prices plummeted over 45% to $2.02 in late December of 2015. To put that in perspective, that's more than $2 per gallon lower than the $4.11 Americans were paying in July 2008. On average, Americans spend over $2,000 per year on gas. The drop in pump prices put money back in consumers' wallets, giving them more money to spend in other areas like cars, electronics, and other consumer goods. Bear with me a moment while we have some technical difficulties. There we go. On the flip side, low oil prices hurt energy producers like oil companies who have been forced to shut down many projects in the face of these historic lows. Between December 2014 and December 2015, the number of U.S. drilling rigs fell by over 60%. The negative impact of low oil prices can also be seen in construction, engineering, and other industries associated with oil and gas production. Domestically, the economies of big oil-producing states like Oklahoma, Texas, and North Dakota have been impacted by layoffs and revenue losses from closed-down projects. We see that pain in the performance of the energy sector, which we can see in the chart on this slide, dragged for most of 2015. The effects of cheap oil are also felt in the alternative energy sector since consumers no longer feel the need to seek out alternatives to expensive fossil fuels. For countries that depend on oil for revenue, lower prices hurt the economy and may raise geopolitical risks in the Middle East and other areas. The Federal Reserve also played a big role last year. After months of anticipation, the Federal Reserve finally raised rates in December for the first time since 2006. Why did the Fed raise rates? Because it believes that the economy is doing well enough to return to normal interest rate policy. See, the Fed has two mandates. low unemployment, and stable inflation. Unemployment has been hovering around 5% for months, and the economy is doing reasonably well. Now that economic activity is picking up, the Fed has to worry about inflation overheating. The Fed delayed a rate hike for several months because of international growth concerns. While many of these concerns remain, the Fed is confident enough in the economy's recovery to start raising rates. How much did the Fed raise rates? After all the fuss, rates went up just 0.25% after they've been held near zero since June of 2008. We don't know what the Fed is going to decide to do this year about rates. What we do know is that policymakers are watching the data very carefully. The numbers on the right side of the chart show Wall Street projections for where rates will be over the next 2 years. We can see that by December 2016, rates are projected to be up 1.1% and maybe up to 2.2% by the end of 2017. Compare that to where rates stood in June 2007. That's a big difference, 5.25%. Now that's not to say we're not keeping an eye on how rates will affect the markets this year. Higher rates will ripple across the economy in the form of higher mortgage and loan rates, higher credit card rates, and higher rates on bonds and other fixed income investments, which most investors will gladly smile upon. While the United States continues to see economic improvement, the story is quite different in many emerging market countries. Brazil, Mexico, Turkey are struggling with slowing growth, rising interest rates, corrupt government, terrorism, and other issues. Low commodity prices affect countries that depend on sales of oil, copper, and natural gas to power their economies. Slowing growth in China affected countries that depend on exports to the world's second largest economy. A strong dollar means weaker currencies relative to the dollar. While that's good news for countries that sell a lot of exports because it makes their goods cheaper, it's a double-edged sword. Many of these countries borrowed money in US dollars and will have a hard time paying off the increasingly expensive debt. The debt is compounded by rising interest rates. Higher rates have historically made the dollar stronger and will make borrowing more money expensive for these emerging market countries. We know that 2015 was a bad year for terrorism. Violence in places like Iraq, Afghanistan, Syria, and Nigeria spilled over, and we had several terrible, high-profile incidents in major cities like Paris. This chart shows the number of reported terrorist attacks around the world in 2014. We don't have data for 2015 yet, but statistics show that between 2013 and 2014, the global number of deaths from terrorism increased by 80%. Let's take a moment to think about that. It's terrible that we live in a time and place where terrorist incidents happen on a regular basis. And we can probably assume that terrorism isn't going away anytime soon. In fact, it's something that we may be dealing with for many years to come. However, as Americans, we are incredibly fortunate. You can see by the chart that the vast majority of incidents happen in the Middle East and North Africa. North America is incredibly lucky to experience relatively few incidents, but it's important to think about worst-case scenarios. So let's think about how a major terrorist incident could affect the economy and markets. I'm going to introduce a term here that some of you may have heard before, a black swan event. A black swan is an unpredictable or unforeseen event that can have extreme consequences for markets. The mortgage meltdown was a black swan event. The fall of the Soviet Union was a black swan. September 11th was a black swan event. September 11th was the worst terrorist event in U.S. history, and it struck downtown Manhattan, just blocks away from the New York Stock Exchange. The market didn't reopen until September 17th. From the beginning of September to the market bottom on September 21st, the S&P 500 lost 14.75%. putting it firmly in correction territory. However, markets didn't stay down. By the end of 2001, the S&P was up again by nearly 19%. Can the past predict the future? No, but we can use it as a guide. The point is here that even a major terrorist event would not necessarily spell disaster for our capital markets. China was one of 2015's biggest market stories. After several years of slowing growth, China's central bank shocked the world by devaluing the yuan, causing markets around the world to reel. Devaluing a currency helps make it cheaper for foreigners to buy Chinese goods and was widely seen as a dramatic move to stoke economic growth. China's economy is the second largest in the world, and it has been a big powerhouse of growth for over the last decade. In this chart, you can see that in 2016, growth is expected to slow to 6.7%. That's a big drop from the halcyon days of 2010 when China's economy grew over 10.5%. However, that is far from a recession. Europe also struggled with anemic growth last year. Though the EU has made great strides in addressing economic issues, countries like Italy, Spain, and Greece have yet to recover from the financial crisis. Though economic growth is slowly coming back, issues like political crises in Greece, refugees, and economic policy were hampering the way forward. Europe also lacks confidence in its recovery and doesn't have a clear path to success. You can see in this map that some countries have been affected by growth woes more than others. Germany, for example, has experienced a decline in exports due to waning demand in China. That's the however, despite challenges, Europe's economy is in its third year of recovery, and policymakers expect 2016 to see more modest growth. On the map, you can see that only a small handful of countries will see growth in the 3 to 4% range. Most EU countries will see slower growth, though only Greece will be in negative territory. Though we're confident that the U.S. economy is on the right track, we know that the stock market doesn't always follow the economy. One major indicator that we like to look at to gauge the health of the economy is consumer sentiment. Essentially, this is a survey that asks regular Americans how they feel about the economy and their financial prospects. It's an important indicator because sentiment has a strong relationship with consumer spending, which drives 2/3 of our economic growth. Sentiment can also be tied to market performance. If you take a look at this chart here, you'll see that the dots show highs and lows in consumer sentiment. And below that, the subsequent 12-month return of the S&P 500. What you'll note is that sometimes when consumer sentiment was high, stocks performed badly afterward. That's what happened in January 2000 and again in January 2007. In January of last year, sentiment peaked at levels not seen since January 2007. And what happened? We had a choppy, flat year for stocks. Why is that? Well, it's complicated, and there aren't some simple cause and effect relationships between these indicators, but high levels of consumer sentiment can be a sign of irrational investor exuberance when prices are bid upward to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment. We see those recessionary periods on this chart as vertical shaded areas. Is that always the case? No, we can see that it wasn't the case in 1977, 84, or 2004. But it did happen in 72, 2000, and 2007. As you can see on the far right, we ended 2015 down from the optimistic high reached in January. However, sentiment is still strong, and that can be a contrarian factor indicating that markets might be getting too optimistic. It's something we're keeping an eye on because it's an indicator that the market could trend downward. I like how Warren Buffett phrases it, be fearful when others are greedy and greedy when others are fearful. What does that mean for us? Don't get too caught up in what others are thinking of doing. Be cautious, watchful, and prudent about managing risk, even when the crowd is going the other way. Let's talk about inflationary trends for a moment. Inflation is defined as a general rise in the prices of goods and services, and one is another key indicator of economic well-being. Though the relationship between inflation and the stock market is complex, all things being equal, stable, modest inflation is better for equities than higher volatile inflation. If you take a look at the box in the middle of the chart, you'll see several acronyms. CPI stands for Consumer Price Index, and the CPI headline is the most popular measure of inflation. It's put out by the government and tracks price trends in a large number of goods bought and sold in the U.S. Core CPI, below it, strips out volatile food and fuel prices to focus on long-term inflation trends. You can see that the light blue CPI line jumps around much more than the darker blue core CPI line. That's because food and energy prices tend to be very volatile in the short run. As of November 2015, the headline CPI was well below the 50-year average at 2%. And the Federal Reserve expects it to stay modest in the months to come, which is good for economic growth. Though the past doesn't always reflect the future, historically a sudden run-up in prices has often presaged or accompanied a recession. Note the huge inflationary spikes during the 70s oil crisis and the 80s recession. Recessions here are shown as gray shaded areas. These were periods when a number of factors sent prices spiraling out of control, taking years for the economy to recover. Fortunately, that's not a problem we have to deal with right now. All right, now that we've looked at what happened in 2015, let's discuss 2016. So what are the experts saying? Here's a list on the slide to the right from several strategists, their firms, and their 2016 S&P 500 target. Now, these targets aren't ours. They are what the experts are predicting. Despite all the challenges facing us going into 2016, these experts are predicting an average of 7.3% growth this year. Of course, as we stated earlier in the presentation, we're not trying to foretell the future. No one knows for sure what equities will do in 2016, and predictions at this stage are pretty foggy. However, it goes to show that there's still optimism on Wall Street. Now, after saying for several years that we think fundamentals support strong equity returns, now we're somewhat more guarded on our predictions. The market rally has gotten a little long in the tooth, and we have some headwinds that we really need to consider. When analysts and economists start making forecasts about the future, they turn to leading economic indicators that help them project how different segments of the economy will perform in the months ahead. Individually, any given indicator may not tell you much, but looking at many of them over time, a picture begins to emerge. This chart shows a composite index of 10 different leading economic indicators. By looking at the overall trend in these indicators, we can get some hints about what's coming in 2016. As of November of 2015, though the growth rate of the index is still declining, it's still positive and would have pretty far to go before turning negative. Let me draw your attention to two other points on the chart. The past performance can't predict the future. Let's look at some history. The shaded region in the chart represent recessions. Take a look at the period preceding the two recessions on this chart. Do you see how the index dropped below zero in the month before? That's a big clue that the economy is heading for a downturn. Now, do you see that pattern appearing now? No, because overall, economic fundamentals are trending in a generally positive direction. That supports continued economic growth in 2016. However, the picture is less than perfect. In the shaded box on the middle, we can see that the strong U.S. dollar has weighed on the manufacturing sector and that unemployment claims are still higher than we'd like. However, other areas of the economy are doing well. According to the Conference Board, the group that created this composite of leading economic indicators, the economy remains resilient, though expectations are moderate. Interest rates are going to play a major role in 2016, though the Fed seems likely to continue to raise rates this year. As we discussed earlier, those raises are likely to be slow and steady. This table shows forecasts created by the Federal Reserve of where it expects certain key measures to be in the next few years. I want to draw your attention to the federal funds rate. That's the interest rate that the Fed controls, and that plays a big part in determining interest rates in the U.S. At the end of 2015, the Fed raised the target rate to 0.4%. By the end of 2016, it anticipates raising it to around 1.4%. Now compare that to the long-run rate of 3.5% on the far right. We're talking about baby steps here. Predictability is key to avoid a market overreaction. The Fed has been doing a great job of telegraphing its plays and giving investors time to adjust to future changes. The Fed also expects the economy to grow at a nice, steady pace, not too hot and not too cold. Are investors right to worry about interest rate hikes? History suggests probably not. To put things into perspective, consider what the S&P 500 returned over post-rate hike periods according to the UBS US 2016 Outlook. On average, the S&P returned over 33% after the first rate hike. So 77 was 41%, 86 was 34.7, 88, 41, 99, 11.3, 04, 37. December 2015, we don't know yet. While past returns are by no means a guarantee of future results, we can clearly see from these examples that interest rate hikes don't necessarily mean calamity for equity markets, contrary to what some naysayers would have you believe. Excuse me, we'll share more specific forecasts in a little bit. Another indicator experts are looking at is where the stock market is now. Stocks have been hovering near historic highs for some time. On May 21st of last year, the S&P reached a new record close of 2130.82, and it spent over 75% of the year within 5% of that all-time high. You may have heard a number of pundits talk about the dangers of reaching all-time highs in the stock market and how the rally can't be sustained at these new levels. However, if you take a look at long-term trends, you can see that from 2000 to 2010, the S&P 500 was largely flat. That's more than 10 years without significant growth because it took us so long to dig ourselves out of those two bear markets. The market experienced the same pattern between 37 and 48 and again between 66 and 74. What happened after those plateaus? The market experienced extended periods of growth. We can't predict the future, and we won't tell you there aren't significant headwinds facing the markets this year. However, the historical pattern is one of plateaus followed by breakout growth, and we can add it to our pro column for stock market growth this year. Of course, we will probably see some dips along the way. That's normal. If there's one thing we want you to take away from this presentation, it's that volatility is here to stay. There are a lot of headwinds and tailwinds pushing market performance around. Markets have been running high for several years now, and it's not unreasonable to see some movement in the other direction. That's part of the reason why we have presentations like this one. We want to prepare you for pullbacks and show you some of the data behind the headlines. We also want to give you the confidence that this knowledge provides. Last year, the stock market experienced several periods of severe volatility and one major dip. But history tells us that intra-year dips are normal. This chart shows in green the annual return of the S&P 500 since 1980. The red numbers below show the biggest drop from the S&P experienced that same year. Some of those dips may have happened in one day. Some may have occurred over weeks or months. As you move along the chart, we can see that even in positive years, stocks experienced a serious dip that might have made investors nervous. However, history shows that these drops are typical. In fact, the S&P 500 has experienced average inter-year declines of 14% since 1980. Despite those declines, annual returns were still positive in 27 out of 36 years. So what does that tell us? Even when we see small retracements, it's not a big deal and we shouldn't panic. While we don't worry too much about pullbacks and corrections, we definitely don't want to see another bear market. So is a bear market coming? That's the trillion-dollar question, right? First, let's talk about the difference between a bear market and a correction. By definition, pullbacks are dips of at least 5% from a recent high. Corrections are dips of at least 10% from a high. As we saw in the previous chart, pullbacks and corrections happen with some frequency, and we typically view them as short-term blips that can offer buying opportunities. Bear markets are corrections of 20% or more and usually represent a sustained period of pessimism. Those are more concerning because it can take quite a while to come back from a bear market. Now, we saw several pullbacks and one major correction last year, but no bear market. Does that mean that a continuation of the bull market is guaranteed? Absolutely not. Volatility is all but certain this year, and we're facing down serious headwinds. However, we're not seeing the excessive valuations, irrational exuberance, or indicators of a recession that we might expect to see at the end of a bull run. Though we expect to see continued volatility in 2016 and aren't ruling out pullbacks or possibly another correction, we aren't seeing the overvalued market sentiment that often presages a bear market. Two emotions drive investor sentiment: fear and greed. This chart is a composite indicator put together by CNN to gauge how investors are feeling. At the end of December, sentiment was stuck in neutral. That means investors aren't feeling particularly greedy or fearful, but are sitting tight and waiting for more information. That means that investors aren't feeling too bullish or too bearish. Though the stock market and the economy don't always move in tandem, over the long term, stock market performance tends to mirror the economy. While some folks are out there predicting an end to the bull market, we don't think it's going to end this year. And here's one reason why. So if a bear market are often triggered by recessions, do we have to worry about a recession this year? We're looking at one set of leading economic indicators earlier. Now we're going to look at some more. This slide takes us back to early 2008. Here we see a group of 20 indicators that help forecast what pressures will be acting on the economy and financial markets in the next 3 to 6 months. Green is a positive for the economy. We could call that a tailwind pushing economic growth along. Yellow is a caution, and red is a headwind that acts as a brake on economic growth. Here we are in January of 2008, about 8 months before Lehman Brothers collapsed in September 2008. Note that there's a fair number of yellow and red indicators long before the recession actually started. The economic outlook is negative, energy prices are rising, and the housing market is also a red flag. Here we are in July 2008, again, months before the real trouble began. Note that the green is disappearing and more indicators are turning red and yellow. Now we're seeing job creation slow down and credit markets start to seize up. Now we're in December of 2008. Lots of red on the board. The economy is in serious trouble. The housing market is deep in the red. Volatility is high. The global economic outlook is negative, and business spending is dropping. Now we fast forward a couple years to February 2010. It's a pretty different picture, right? At this point, there are a lot more positive pressures acting on the economy as we start digging ourselves out of the hole created by the financial crisis. The economic outlook is good, and with monetary policy helping, the Fed lowering rates and pumping money into the financial system, companies are also starting to feel more upbeat about their prospects. Here we are today. As of December of 2015, you can see that we have some areas of concern in the next 3 to 6 months. Analysts worried about geopolitical risks like terrorism. They are also thinking that political battles in Washington may harm the economy. The global economic outlook is also looking weak. However, we have a lot going for the economy as well. All this is to say that we don't see a lot of recession pressure the way we did back in 2008. Right now, the board's looking pretty green. Now, the past can't predict the future, and financial markets don't always act in concert with the economy. However, barring some unexpected economic shocks, we're pretty confident that we won't see a recession this year. Here's what Wall Street economists are predicting for GDP growth this year. 2.2 for Q4 of 2015, 2.5 first quarter this year, 2.7 for the second quarter, and then 2.6 for the rest of this year. I think these are high. We've already seen a reduction in Q4 expectations down to 0.7. So even if these are high, though, we're still in positive territory. Americans will spend a lot of time this year watching the presidential election race leading up to November. Every time elections roll around, investors ask, how will the election affect the stock market? What will happen if so-and-so winds up in the White House? While we can't predict the future, we can look at some historical charts for perspective. This chart shows a history of election years between 1990 and the last presidential election in 2012. There are two big takeaways in this chart. One, stocks tend to do well in a presidential election year. On average, the Dow returns 7%. That's pretty darn good, especially considering last year. The second point is that regardless of whether a Democrat or Republican won the election, stocks perform better when the incumbent party won. Why? That is, I'll leave up to you. Here's another chart that shows how the S&P performed during the last 10 election years. You can see that with the notable exception of 2000 and 2008, the S&P has delivered positive returns in election years since 1976. Let's remember that in 2000 we had the dot-com crash and in 2008 the financial crisis. All told, I think we can say that historically election years don't have much effect on overall returns. Now that's not to say we won't see volatility and uncertainty in the period leading up to the election. That's probably a given, since investors hate uncertainty. Elections do have a profound effect on policy, and there are a number of short and long-term issues that we need Washington's help with. If politicians can't work together to address issues like national debt, Social Security, economic policy, and wage growth, then markets may suffer. We saw that during the fiscal cliff debacle and other periods of political gridlock. As a voter, focus on what's important to you and make decisions that resonate with your values and perspective. As an investor, take several steps back from the rhetoric and the hype and don't let them dictate your major financial decisions. If you'd pull out of the markets in 2008 or 2009 because you were unhappy with the election, you'd have missed out on all the growth we have seen since then. So where do we go from here? Here are a few of the major trends that we and many of the experts we consult are looking at this year. On the negative side, we're looking at economic slowdowns in China, Europe, Brazil, and many other places around the world. We may have seen the worst already in China. However, we could see more evidence of a serious slowdown, which could spread around the world. Emerging markets will be hurting because of low oil prices, government debt tied to U.S. interest rates, weakening currencies, and other issues. They borrowed a lot of debt at low rates. What will happen when rates go up? A strong dollar makes U.S. exports more expensive, which hurts U.S. companies that depend on foreign demand. We see that being an ongoing concern. The Federal Reserve will probably continue to raise rates. If they do so too quickly, it could put out the economy's flame. We're also thinking about terrorism and other potential black swan events that could throw a big curveball at the economy. In the caution column are high equity valuations and the political environment. These could cause problems, but won't necessarily be an issue this year. But on the positive side, and we do have a positive side, we believe that a strengthening labor market will continue to support economic growth. We're not expecting to see tremendous GDP growth we're talking. Instead, we think, always assuming the negatives don't take over, that we'll see a continuation of the plow horse economy. Slow, steady growth, a stronger labor market should translate into wage growth, which will hopefully boost consumer spending. As long as inflation remains stable, it'll be an indicator of economic growth. The European Central Bank is trying to fuel growth in Europe through quantitative easing. We hope to see that put Europe's economy back on track. Now, we want to prepare you for a couple of negative scenarios that could arise. One, U.S. companies could experience weaker profit growth because of slower than expected economic growth. If that happens while U.S. wages are growing and interest rates are higher, corporate profits could get squeezed, and that could drag on the equity markets as the year progresses. Another negative scenario could be if inflation ends up being higher than expected because of rising wages and job growth. That could trigger more aggressive rate increases by the Fed. So even though this presentation is about 2015, I want to take a moment to talk about the pullback we experienced in January. During the first couple weeks of the year, markets dropped off after more disappointing data out of China continued and weakened oil prices. We all remember what that felt like. How did it feel? Probably a bit stressful, maybe even a lot stressful. Here's one thing. 2016 is going to be a volatile year. Some experts say that January sets the tone for the rest of the year. Maybe it does, maybe it doesn't. I'm always leery of those kinds of predictions because markets can and do swing on a dime. There's one thing I want you to take away from this presentation, it's this. Markets are dealing with a lot of uncertainty this year. As we saw on the previous slide, there are a lot of factors pushing and pulling, and I want to give you some tips on dealing with volatility and corrections. Now let me repeat what I said before. Corrections are a normal and natural part of the market cycle. According to research, the stock market experiences a correction about every year, and the average corrections last about 14 calendar weeks. While we can't predict these corrections or their duration or accuracy, here's what we do know about them. First of all, turn off the television, stop reading the stock market pages of your newspaper. Honestly, that's why you have a professional. We do the worrying for you, and we'll tell you what's going on. Second, focus on your own goals. Are you living comfortably? Can you afford the things you want? Corrections only matter to short-term investors who are jumping in and out of markets. Remember what we saw on the chart of intra-year dips. They're a blip on the radar to long-term investors. Third, stay flexible and active. One of the benefits of working with us is that we stay on top of the markets and are constantly doing analysis to find opportunities to help our clients thrive during these different market environments. That might be rebalancing, that might be changing holdings, subtle changes to inspire confidence and help us ride out this volatility. Fourth, avoid making emotional decisions. Hitting the panic button during a decline is often the worst thing you can do. Periods of high growth frequently happen shortly after a pullback. If you're not in the market when it moves, you could miss out on the best days of performance. Finally, talk to us. If you're worried or have experienced life changes that affect your portfolio, we need to know about it. We want to be your first phone call whenever you're going through something that involves your finances. What can you do in 2016 to move toward your family's goals? Here are some action items for you. If something changes in your life or personal situation, keep us in the loop. We want to hear about important family events, like births and deaths. We also want to know about health issues, changing in your employment, and any financial changes like inheritance that may change your situation. We also want to know about any changes in your feelings about risk in your future goals and any concerns you have about the market environment. We also would like you to go over your estate documents, beneficiary designations, and other paperwork to make sure it's all up to date. So here are our action items for the year. For us, we want to keep you informed through regular communication, manage your investments according to your personalized strategy, and stay on top of changes in the market and make prudent adjustments where necessary. Any questions? So this concludes today's presentation. For more information and timely updates, please follow us on social media. We hope that you enjoyed the information we shared, and we'll be around to answer your questions whenever you call the office. Thank you, and have a great day.